Hey guys, it's Rudy coming at you live from sunny West Palm Beach in Florida. It is Sunday. It is August the 10th, and today we're gonna talk about energy. You know, that stuff that makes the world go round. So, as a follow-up to the previous video that I made, which was about 10 small cap mining or micro cap mining stocks that you can invest in this one, we are going to exclusively talk about energy, although some of them overlap just a little bit. The first one I'm going to share with you is a little bit quirky because this is a dividend energy portfolio specifically. And if you look at the highlights on the screen here, I have a few high-paying dividend stocks. One of them has an X next to it. That's Lukoil from Russia. I'm not allowed to have that anymore because of sanctions, although it appears in my brokerage statement and account as no name. I have a couple of thousand shares there, and it's worth a bit of money because the last time I looked, Lukoil was trading at the equivalent of about 65, 67 cents per share. So what I am going to focus on are the ones that I'm actually allowed to own and have in my portfolio. A couple of ones that you're probably familiar with, like Petrobras in Brazil and Ecopetrol in Colombia. And then you probably have never heard of Grania Megan, which is coal in Indonesia. Var Energy is from Norway. Norway is that country that is masquerading as a country because it's actually an oil company. And the other one is Surge Energy out of Canada. Now, these stocks have something in common from the point of view that they are sort of energy type stocks. Maybe coal is a little different because mining, but they are also quite different. Before I get into the presentation, I just want to briefly mention that any cash awaiting investment I have is usually parked in ETFs. In other words, you don't want cash to just sit there dead and declining while you can actually make some money on it when you park it in an ETF. I do keep a cash position of around 2 to 10%, depending on the account and depending on the risk tolerance of the person whose account it is. And as a general rule, I will take money out of something like XLE, which is an energy ETF, to invest directly into an energy stock if I feel the opportunity is good and correct for me to do so. So in this particular video, I am talking firstly about five stocks that I just mentioned a minute ago. And you will notice here that you can buy them from prices that range from around $3 to about $12 or so. They are all arguably undervalued. They are not the same as I mentioned. So Ecopetrol is an integrated oil company. Um, Indo Tabagranya Mega is coal, and Petrobras is emerging markets integrated. Surge is a Toronto Stock Exchange oil and gas company, and Var Energy from Norway is an oil and gas company. You can see they're jurisdictionally diversified, and they are also somewhat diversified in terms of the commodity because they are similar but not the same. If we look at the 20-day raw stochastic very briefly here, if it dips below 20, it's somewhat oversold. None of them are below 20, but this is getting close at 39, and it's hopelessly overbought if it's above 80. We have Petrobras here at above 80. I don't think it's overbought at the current price, but this is just a technical indicator, right? So you don't use them in isolation, you use them in combination with other things too. So I disagree that the Petrobras stock at the current trading price of 11, $12 is overbought. The price earnings ratio for all of them look pretty good. The most expensive one here is Surge Energy, but even that is cheap based on a price earnings ratio of around 13. The market is currently trading, the S&P 500 as a whole is currently trading at around 21, 22. So anything below 21, 22 is good. So even Surge at 13 is actually relatively well priced. Today's opinion, today of course is Sunday, but I took these snapshots during the week. The analysts are sort of 100% in agreement that Surge is a buy. I mostly agree with that. I disagree with Ecopetrol. It's not mostly a sell. That probably at $8.68 is a buy, but I'll leave you guys to be the judge of that because you're much smarter than me. The market cap is interesting. I mean, these are not necessarily small companies. The smallest of the lot is Surge with a market cap of around $715 million. What is interesting here is, and the reason why I added these check marks here is because look at these companies. Ecopetrol is producing approximately $146 billion in sales with a market cap of only $17 billion. Petrobras, $91 billion, $76 billion. And then even Surge is close, right? $665 million in annual sales, only $715 million as a market cap. They all pay a dividend, but let's look at that in a little bit more detail in the suck factor graph. And the reason why I called it that is because the average return, because oil and gas has taken a bit of a hit over the past 1 year, is only 6.6. I don't have a pie chart for these five stocks because they actually occupy, from a weighting point of view, exactly the same position. So if you think of it just from a practical point of view, if I had invested $5,000, it'd be at $1,000 in each of them. So it doesn't make sense for me to show you a pie chart because all the slices would be almost exactly the same size, right? Average return 6.6% per year, but here's the kicker, right? The average dividend is 16.6. So if you add the two together, it's almost 23% in terms of the 1 year return in an environment where the market for energy stocks specifically has actually pulled back quite significantly, right? Top performer plus 28, worst performer minus 17, which is sort of in line with the average dividends. But look, take a look down here at the bottom. Eco Petrol 27, 28%, Petrobras almost 20%, VAR Energy 13%, Surge Energy is 7%, and Tabo Grania 15%. So if I average them all out, because they're all equal proportioned or weighted in my portfolio, 16.6% across this portfolio. So this is a very unique portfolio because it's specifically a dividend hedge for energy in general. So let's go one level deeper and we look at the large cap dividend energy stocks. And the reason why I call them dividend energy stocks is because most of them pay a dividend. Now, I've only made one change here because you'll see on the highlights here. Firstly, they are all North American stocks, so Canada and the United States, excluding Mexico. And the highlights that I have here is Enbridge. I'm skipping this one for a second. Phillips 66 Energy Transfer and Alliance Resources. If I had done this same video a few months ago, I would have had Exxon highlighted here. Instead, I've highlighted Cameco. Now, Cameco, to be fair, is actually a mining company because they mine uranium, but I'm going to include Cameco because uranium is the feedstock for nuclear energy. So I'm basically saying my two Canadian energy stocks, even though Cameco is strictly mining, are Enbridge and Cameco, and my three American or US domiciled energy stocks are Phillips 66 Energy Transfer and Alliance Resources, which arguably is also a mining company because it's coal. But let's go one level deeper on this one. So on this one, I can show you a pie chart, chai part. It's almost the same thing, right? English is my third language. But anyway, Enbridge around 20%, Energy Transfer around 35%, and Cameco around 18%, and Alliance Resource Partners at around 17% are my four largest holdings. Exxon, you see, is down to 1.1. I sold some Exxon to buy other stocks, including mining stocks, and to buy some Surge. Now, the reason why specifically Energy Transfer, by way of an example, is larger and much larger than the other slices on this pizza pie is because I reinvest all my dividends and I've had Energy Transfer in my portfolio for quite a few years. To be totally honest with you and transparent, my original investment from a cost basis point of view in Enbridge is even less than what it is for Energy Transfer, but yet the pie chart shows about the same kind of value for Enbridge as it does for Alliance Resource Limited Partners and Cameco. Enbridge has been in my portfolio for a very, very long time as well, and I've reinvested the dividends, and that's how it got up to 20%. There's the price you can buy these for right now. The most expensive one is Exxon. I'm going to come back to this one in just a second because I'm going to include Exxon here just because the comparison is more realistic and fair. I have oil, and then Alliance Resource Partners coal. And then you can see over here at the bottom, I added LP. These are limited partnerships, Energy Transfer and Alliance Resource Partners. If you own these, you also will receive a K1 for your tax filing, which might complicate your tax filing a little bit. If you don't like that, you can just skip these and just invest in the stocks that you can buy on the exchange. If we look at the 20-day raw stochastic here, I have a few check marks. I'm saying, using the same example earlier, if it's above 80%, it is overbought. I have one of those, that's Enbridge. And in addition to that, its PE right now is market related or even higher than the rest of the market. So we skip that one. We look at the others instead. Even Exxon has a reasonable PE ratio, but the best buyers are the two limited partnerships, Alliance Resource Partners and Energy Transfer. Alliance Resource Partners is a stock that should be trading at around 28, maybe even $30, and Energy Transfer should be trading at about 20, maybe $21. So they are cheap right now and probably are buys, even though the analysts, who are much smarter than me, are saying sell, 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 sell. Ironically, they say buy Enbridge, and I'm saying don't buy Enbridge right now. The price is too high. Wait for a pullback. Market cap, once again, if we look at these companies, a $2.4 billion revenue company with a market cap of only 3.3. But we need to look also at the benchmarks as it relates to return on equity and return on assets and things like that, if you want to use this as a benchmark or guideline for why you should invest or not. How about Energy Transfer? $82 billion in sales with a market cap of only $61 billion, right? So the annual sales far exceeds the market cap of the company as a whole. They all pay a dividend as well, but let's go to the next page and I'll show you the suck factor on this one, which is more of a suck factor than the previous one. Average return, 1.7% for the past year, and average dividend, 6.5%. So if I add these two together, I only have about an 8% return year over year. My top performer is only 12%, and my bottom performer is negative 8%. Remember, I'm striving to earn at least 15% on a compounded return basis annually, because after 5 years, I can double my investment every 5 years if I can grow by 15% or higher or thereabouts. Now, I've averaged the dividend here across four stocks: Alliance Resource Limited Partners, Enbridge Energy Transfer, and Phillips 66, because my Exxon position is down to just 1.1% in my portfolio. So it's almost gone. And I might sell out the rest of it and just exit Exxon completely, because I get much better return on investment and a much better dividend yield from some of the other stocks I've already shared with you, including in the previous video with the mining stocks. Now, let's look at two contradictory opinions here. The first one is from the U.S. Energy Information Administration. Many people call this a U.S. propaganda news site, but for what it's worth, I'll just refrain from including any accusations and just read the news for you instead. So this AEO 2025 simply means the Annual Energy Outlook for 2025, which was released in April 2025, projects a decline in total energy consumption through 2040, followed by an increase obviously after 2040. So I will just say here that there is absolutely no way that these people can possibly predict what the energy consumption is going to be through 2040, especially followed by an increase. That is just absolutely outrageous. I would rather say, based on current consumption, which is about 104 million barrels per day, that every single day, every week, every month, every year, we just use a little bit more than before. And the countries where, or jurisdictions where most of the growth is happening, especially in Asia and Africa, are consuming energy now like never before. So for the EIA to say there's going to be a decline or projected decline through 2040 is absurd, given where we are currently. I mean, to be fair, these are people who struggle to tell you what the weather is going to be like tomorrow. So I'm not buying this at all. Driven by efficiency gains and evolving regulations, how on earth could they know what the evolving regulations are going to be from now to 2040 and beyond? We don't even know who's going to be the administration or the president in charge in 3.5 years from now, never mind what evolving regulations are going to happen in 2040 and beyond. It also anticipates a significant growth in renewable energy generation. That one I can understand and appreciate. And a decline in coal-fired electricity generation. I don't think so. Because just look at this by way of an example. Since the pandemic, sort of 2019, 2020, this is China's construction of new coal power plants, which has reached a 10-year high, which reached a 10-year high in 2024. So, nah, I don't think so. How about we get the contrarian opinion? One of these is right. You can pick which one, and then you can let me know in the comments which of the two you agree with more or less than the other. OPEC says oil demand will rise by about 19% to 123 million barrels per day by 2050. So let's just break that one a little bit. That's more than 25 years from now. We currently use 104 million barrels per day, approximately. And they say it will increase by about 20% over the next, whatever, 20 years or so. That one is easy to understand. I believe that one. I'm in the OPEC camp on this one. This forecast contrasts sharply with the IEA projections of demand peaking by 2030. Well, we covered that one already, right? So those are two sort of contrarian views. One is in direct opposition to the other. So that's kind of the wrap on this one. What do you guys think? Because this is my question time where I get to the point where I say, any of these stocks that I just discussed with you, are they buys or are they sells or are they holds, or do you just avoid them and run for the hills, right? So before I go, I just have a couple of things to ask of you. If you like my content, please subscribe, because it keeps me motivated and encouraged to do more videos like this for you. And the other thing that you can do is comment, because you know by now I read them all. And if you give me a good comment, I will respond to that as well. And I look forward to chatting with you in the comments and taking the discussion a little bit further. So where are you on energy right now? Let me know, and let's get the discussion started. Take care. Bye bye.